Is this the end of centralized exchanges? For years, we've trusted giants like Binance and Coinbase with our crypto, but a revolution is brewing on the Solana blockchain that's changing everything. We all got used to the convenience, the familiar apps, treating them like the banks of the digital world. But that convenience came with a hidden cost. A cost we've seen in catastrophic failures, frozen funds, and a complete betrayal of what crypto was built for. We took our decentralized assets and handed them right back to centralized gatekeepers, and in doing so, we handed over all the control. Well, that era of blind trust is over. A great migration is happening, a quiet exodus from these walled gardens into a new, open financial world. And it's not a trickle, it's a flood. The evidence is undeniable. As of late 2025, Solana's on-chain activity is exploding. We're seeing daily active wallets in the millions and daily DEX trading volume hitting nearly $3 billion. These aren't just numbers on a screen. They represent millions of users actively choosing a different path, a faster, cheaper, and more sovereign way to handle their own money. With so many unique wallets already diving into DEXs, the real question is, are you ready for what's next? To understand where we're going, you have to know how we got here. Centralized exchanges, or CEXs, weren't born evil. They were a necessary tool. In the early days, buying Bitcoin was a huge pain, a digital scavenger hunt for the tech savvy. CEXs fixed that. They built the bridges from our bank accounts and our fiat dollars into the world of crypto. They gave us easy-to-use apps, customer support, and the illusion of safety. For a while, they were the essential on-ramps for a whole generation of new crypto investors. Their dominance was built on that convenience. Platforms like Binance, Coinbase, and Kraken became household names, processing trillions in trades. They seemed too big to fail, but under that shiny surface was a massive contradiction, the original sin of putting centralized control in a decentralized world. The whole point of blockchain, the revolution Bitcoin started, was to get rid of trusted third parties. It was about a system where you and only you control your money. The mantra was and still is, not your keys, not your crypto. And what did we do? We bought these revolutionary, self-sovereign assets and then immediately handed them over to someone else to hold. We put our crypto in their wallets, traded on their private books, and trusted their promises that our funds were safe. This single act created a giant glowing target, a honeypot of value that went against everything crypto stood for. It was never a matter of if this model would break, but when and how badly. The risks weren't just theories. They were hardwired into the CEX model, just waiting to blow up. The history of crypto is a graveyard of failed centralized exchanges. Long before the world knew the name Sam Bankman-Fried, the crypto community was all too familiar with the sting of CEX collapses. The fall of FTX wasn't a one-off event, it was just the loudest and most spectacular failure in a long, painful line of them. It was a pattern playing out over and over again. Let's rewind. Remember Mount Gox? Back in 2014, it handled over 70% of all Bitcoin transactions. Then, one day, it was gone. It filed for bankruptcy after announcing that 850,000 Bitcoins belonging to its customers were just lost or stolen. The fallout was devastating, kicking off a long bear market and shaking confidence in the entire industry. Then there was Quadriga CX in Canada. Its founder died under mysterious circumstances, supposedly taking the passwords to cold wallets holding the funds of 115,000 users with him to the grave. The money was gone, locked away forever. These weren't just hacks. They were total operational failures caused by centralizing control. And this isn't ancient history. The risk is always there. The threat is accelerating. The first half of 2025 saw around $2.47 billion stolen from crypto services, already blowing past the total losses for all of 2024. State-sponsored hacking groups have become brutally efficient, with North Korean actors alone being linked to over $2 billion in stolen crypto by October 2025. And early 2025 gave us one of the largest crypto thefts ever recorded, a massive hack of Bybit that drained nearly $1.5 billion. The ways they fail are different, but the root cause is always the same: centralization. We see outright scams that were just designed to steal funds. We see devastating hacks that exploit system vulnerabilities. We see gross mismanagement, like with FTX, where customer deposits were treated like a personal piggy bank for risky bets and luxury condos. And when one of these titans falls, it creates a contagion. The FTX collapse set off a domino effect of insolvencies that tore through the industry, wiping out lenders, funds, and countless regular investors. Each failure is another brutal lesson. When you give up custody of your assets, you're not an owner anymore. You're just a creditor hoping to get paid. Beyond the headline-grabbing collapses, there's a slower, more sinister threat from centralized exchanges, the quiet erosion of crypto's core values. Centralized companies, which means they answer to governments and regulators, this makes them a choke point, a perfect tool for control and censorship. We've seen it time and again. Accounts get frozen because of political pressure. Transactions are blocked based on nationality or some arbitrary blacklist. In a world with rising geopolitical tensions, your access to your own money on a CEX could depend entirely on the politics between your country and where the exchange is based. This is the exact system of financial control crypto was meant to free us from. On top of that, how most CEXs operate internally is a complete black box. They talk about transparency, but their order books run on private off-chain servers. This opens the door to market manipulation like wash trading to fake volume and mess with prices. We're asked to trust their proof of reserves, but these reports are often flimsy, unaudited, and don't show the full picture of their debts. After FTX asking, "Are the funds really there?" is a question no one can afford to ignore. The very structure of these exchanges lacks the verifiable on-chain transparency that's baked into decentralized protocols. This weakness is made worse by growing regulatory pressure. Strict KYC, know your customer, and AML, anti-money laundering laws have turned CEXs into giant data hoovering machines. They demand your personal info, your ID, your transaction history, creating huge sensitive databases that are prime targets for hackers. This forced surrender of privacy goes completely against the pseudonymous nature that so many people value in crypto. This slow bleed of censorship, regulatory overreach, and murky operations has created a massive ideological clash. It's become obvious that the CEX model, while a decent starting point, is a compromised and unsustainable home for a truly decentralized future. Act 2, the solution, the Solana revolution. But out of the ashes of these fallen giants, a revolution is brewing. It's not a theory or a distant promise. It's happening right now with millions of users and billions of dollars. And the epicenter is the Solana blockchain. This isn't just another crypto, it's a fundamental shift, an ecosystem built from the ground up to solve the core problems that have plagued both CEXs and older blockchains. So, why Solana? What makes this blockchain the gravitational center for this great migration? The answer is in its core design, which gives it an almost unfair advantage in speed, cost, and scale. For years, decentralized trading was held back by the limits of blockchains like Ethereum. While revolutionary, Ethereum was slow and ridiculously expensive. During peak times, a single swap could cost hundreds of dollars in gas fees, and you'd have to wait minutes for it to go through. This made it useless for most people in any kind of active trading. Solana blew that model apart. It introduced a new consensus mechanism called proof of history, POH. Without getting too technical, think of POH as a cryptographic clock that timestamps transactions before they're bundled into a block. This lets validators process transactions in parallel instead of one by one. The result is a network with mind-blowing performance. Let's talk numbers, because they tell the story. Solana has a theoretical throughput of up to 65,000 transactions per second, TPS, with block times of around 400 milliseconds. Compare that to other chains, and it's not even in the same league, but the number that matters most to the average user is the cost. The average transaction fee on Solana is a fraction of a cent, around 2 cents. This isn't just cheaper, it's a total game changer. It makes decentralized trading accessible to everyone, not just crypto whales. It unlocks new ideas, from tiny microtransactions to complex DeFi strategies that would be financially impossible on other networks. And the network is getting even faster. This relentless focus on performance has created the perfect environment for a new wave of financial apps to thrive. Apps that can finally compete with and even beat the user experience of centralized exchanges. Section 5. The fuel for the fire, explosive user growth, and a thriving ecosystem. If Solana's tech is the engine, then the explosive user growth is the fuel. Millions of active wallets are a testament to a mass migration already in full swing. Data from late 2025 confirms this, with Solana consistently leading in active addresses and showing strong developer growth, attracting over 11,500 new developers in the first 3 quarters of the year. But why are they coming? Two reasons. First, users are running from the risks of CEXs that we just talked about, the collapses, the censorship, the privacy nightmares. They've broken the trust of a generation of crypto users. They're seeking the safety of self-custody and the freedom of permissionless finance. Second, they're being pulled in by a much better user experience. They are escaping the insane fees and slow transactions of older blockchains and discovering a world where on-chain activity is fast, fluid, and incredibly cheap. This flood of users has created a flywheel effect. More users attract more developers, and more developers bring more innovation and better apps. This vibrancy was perfectly captured by the meme coin craze on Solana. Some might dismiss it as gambling, but that craze was a massive grassroots onboarding event. Millions of people learned how to set up a Solana wallet, use a DEX, and navigate a truly on-chain world, all because the cost and complexity were practically zero. It stress-tested the network and its DEXs, proving they could handle insane retail frenzies while staying lightning fast and cheap. It was the ultimate baptism by fire, and Solana emerged stronger with a battle-hardened infrastructure and a much larger, more experienced user base. To really get the Solana DEX revolution, we need to look under the hood at the engine that drives it, the automated market maker, or AMM. This is core innovation that makes decentralized trading possible, and it's totally different from how a CEX works. A CEX, like a stock exchange, uses a central limit order book, CLOB. It's basically a big list of buy orders and sell orders. The exchange acts as a middleman matching a buyer with a seller. This system needs a ton of computing power and a central party to manage everything. AMMs throw that all out. Instead of matching individual buyers and sellers, an AMM uses liquidity pools. Imagine a pool with two tokens like SOL and USDC. Anyone can become a liquidity provider, LP, by depositing an equal value of both tokens into this pool. In return, they get a cut of the trading fees. Now, when a trader wants to swap SOL for USDC, they're not buying from another person. They're trading with the pool's smart contract. They put SOL in and take USDC out. The price is set automatically by a math formula based on the ratio of the two tokens in the pool. Think of it like this. A CEX is an auction house with an auctioneer matching buyers and sellers. An AMM is a vending machine. You put one coin in, another comes out, and the price is set automatically. This simple but brilliant idea democratizes finance. It lets anyone, not just giant market-making firms, provide liquidity and earn trading fees. It removes the middleman, creating a permissionless, transparent, and unstoppable trading venue. But this early model wasn't perfect, which led to the next stage of evolution, one that Solana is leading. Section 7, the evolution, concentrated liquidity, and the rise of capital efficiency. The first AMMs, while genius, had a big problem. They were extremely inefficient with capital. In a standard AMM, the money you provide is spread evenly across every possible price, from 0 to infinity. This means that most of the capital in the pool is just sitting there, completely unused, covering price ranges that the token will probably never hit. For example, in a SOL/USDC pool, some of your money is waiting for the price of SOL to hit $1, and another part is waiting for it to hit $1 million. It's a huge waste. This is where the next leap forward comes in, the concentrated liquidity market maker, or CLMM. This technology, championed by leading Solana DEXs like Orca, lets liquidity providers concentrate their capital within a specific price range. Instead of providing liquidity across the entire number line, an LP can choose to provide it only where they expect the most trading to happen, say between $150 and $160 for SOL. The analogy is perfect. A traditional AMM is like a fisherman casting a giant net across the whole ocean, hoping to catch a few fish. A CLMM is like a spearfisher who targets the small area where the fish are actually swimming. By focusing their capital, LPs can earn way more in trading fees with the same amount of money. For traders, this is just as revolutionary. Because the liquidity is so deep and concentrated around the current price, it leads to much lower slippage. The difference between the price you expect and the price you actually get. This makes trading on a Solana CLMM DEX incredibly efficient, often with better pricing than even the biggest centralized exchanges. This tech leap, made possible by Solana's speed and low cost, is what unlocks institutional-grade trading on a decentralized platform. Section 8, the new gateways, a tour of Solana's top DEX. This powerful technology isn't just a theory. It's live and handling billions in volume every day across a vibrant ecosystem of decentralized exchanges. exchanges. Let's take a quick tour of the new front doors to the on-chain economy. First, and most importantly, we have to talk about Jupiter. To call Jupiter a DEX is to sell it short. Jupiter is a DEX aggregator. Think of it as the Kayak or Google Flights of Solana trading. The Solana ecosystem has dozens of DEX, each with its own liquidity pools. Finding the best price for a trade used to mean checking multiple sites. Jupiter does all that work for you. When you enter a trade on Jupiter, its smart routing scans all the major DEX and liquidity sources on Solana in real time. It can even split your trade across several pools to minimize slippage and guarantee you the absolute best price. For most people, Jupiter is the front door to Solana DeFi, a one-stop shop that has become so dominant it handles the majority of aggregator volume on the network. Then you have the liquidity powerhouses that Jupiter pulls from. A prime example is Orca. As one of Solana's original and most trusted DEXs, Orca is famous for its user-friendly design and its whirlpools feature. Its version of the concentrated liquidity CLMM tech we just discussed, Orca has focused on building an institutional grade platform, providing the deep, efficient liquidity that powers a huge chunk of the Solana ecosystem, with cumulative volume now over $400 billion. With daily volumes that can reach hundreds of millions, Orca is a foundational layer for the entire network. Finally, there's Raydium. Raydium was an early pioneer, blending the AMM model with an order book to tap into deeper liquidity. While aggregators like Jupiter have changed the game, Raydium remains a crucial piece of Solana's DeFi infrastructure, especially for new projects launching on the network. Together, this ecosystem of aggregators and underlying DEXs creates a trading environment that is deep, efficient, and surprisingly user-friendly, offering a complete and compelling alternative to the centralized world. Now, navigating this new world of decentralized finance with its aggregators, CLMMs, and liquidity pools can feel complex. There's a lot to learn, and this space moves at light speed. If you want to stay ahead of the curve and get more deep dives like this, breaking down the biggest trends so you don't have to, make sure you subscribe to our weekly newsletter. It's completely free, and the link is right there in the description. It's your weekly dose of alpha to keep you sharp in this fast-moving market. The shift from centralized to decentralized is not a prediction. It's a measurable trend that's picking up speed. The data paints a clear picture. Globally, DEX have been stealing market share. By late 2025, the monthly spot trading volume on DEX had quadrupled in just 18 months, now accounting for nearly 20% of the total spot market, up from around 10% in 2024. In October 2025 alone, DEX saw a record monthly volume of over $613 billion. This means that a huge slice of all crypto trading is now happening on-chain, directly from user wallets, with no middleman. Solana is leading this charge. On any given day, Solana's DEX are collectively processing billions in trading volume. It's not just meme coins, it's a deep and liquid market for major assets, and Solana now often leads all other blockchains in DEX trading volume. This incredible growth is driven by the exact things we've explored. Users are being pushed from CEXs by fear and pulled to Solana DEXs by the promise of self-custody, privacy, cheap fees, and direct access to innovation. New tokens almost always launch on DEXs first, giving on-chain users the earliest shot at the next big thing. This mix of security, performance, and opportunity is what's driving billions of dollars and millions of users on-chain. So, is this really curtains for centralized exchanges? Will platforms like Binance and Coinbase just fade away? The reality is a bit more nuanced. While their dominance as the center of the crypto world is absolutely ending, it doesn't mean they'll vanish. Instead, their role is about to change dramatically. CX will likely evolve from being the main stage for crypto activity to being essential, but specialized gateways to the on-chain world. Centralized exchanges still do a few things really well. For one, they are the main bridge between the traditional financial system and the crypto economy. Their fiat on-ramps and off-ramps, the ability to easily turn dollars into crypto and back again, are still critical infrastructure that DeFi hasn't fully mastered at scale. For total beginners, the CEX experience can still feel more familiar. And for the biggest assets like Bitcoin and Ethereum, CEXs often still offer the deepest liquidity and more complex trading products like regulated derivatives. So the future isn't a world without CEXs, but one where their job is different. They'll be the on-ramps, the place you go to buy your first crypto or cash out back to your bank account. But the real action, the trading, lending, borrowing, and wealth creation, will increasingly happen on-chain. We're already seeing the smartest CEXs adapt. They're launching their own non-custodial wallets, integrating DeFi protocols, and trying to become portals to the decentralized world instead of walled gardens. Their survival depends on embracing this trend, not fighting it. Section 11, the end game, a glimpse into a DEX-dominant future. As we look to the horizon, the end game gets clearer. We are moving toward a future where DEX are the default, the standard, the foundation of the digital economy. Imagine a world where your main financial tool isn't a banking app or an exchange website, but a self-custody wallet on your phone. A wallet that gives you and only you total control over your assets. From this single wallet, you'll tap into a universe of financial services. You'll swap tokens for the best price, automatically routed by an aggregator like Jupiter. You'll provide liquidity to a concentrated pool on Orca, earning passive income. You'll take out a loan, trade perpetual futures, or even buy tokenized real-world assets like stocks or real estate, all from one interface, all powered by transparent, open-source smart contracts. There are no accounts to be frozen, no shady middlemen to trust, no single point of failure. This is a future of radical financial freedom. It breaks down the walls that have defined traditional finance for centuries. Anyone with an internet connection anywhere in the world can access this global financial system. And at the heart of this vision is a blockchain that can handle the load, one that is fast enough, cheap enough, and scalable enough for billions of users. With its relentless focus on performance and its thriving ecosystem, Solana isn't just a contender. It's rapidly becoming the leading candidate to be the foundational layer for this new decentralized world. So, what's the bottom line? The era of CEX dominance is ending. It was a necessary chapter, but it was defined by unacceptable risks, spectacular failures, and a deep conflict with the spirit of crypto. The cracks in the armor have become gaping holes, and users are voting with their feet. A revolution is happening, and it's being built on Solana, powered by incredible speed, dirt-cheap costs, and game-changing tech like concentrated liquidity. A new financial system is being born, a system that's more transparent, more efficient, and most importantly, puts you back in charge. The migration is well underway with billions in volume and millions of users choosing the freedom of self-custody. The shift from CEX to DEX isn't just a tech upgrade, it's a philosophical one. It's about taking back control. The end of centralized exchanges isn't about the death of companies like Binance or Coinbase. It's about the end of an era where we had to trust a middleman with our digital sovereignty. The future of finance is decentralized, and it's being built as we speak. But what do you think? Is this the final chapter for CEXs as we know them? Are you moving your assets on-chain, or are you staying put? I want to hear your take. Let me know why or why not in the comments below. This is one of the most important conversations in crypto right now. And finally, if you got value from this deep dive and you want to stay on the cutting edge, do me a favor and hit that like button and make sure you're subscribed with notifications on. You won't want to miss what's coming next.